April is Financial Literacy Month, which makes it a great time to empower ourselves to make more informed decisions about our money. So I spoke with local financial professional Mike Kojonen tonight about where to start. Mike, thanks for joining us during Financial Literacy Month nonetheless. Tell us about it.
Yeah, well, in 2004, Congress passed a law claiming April as Financial Literacy Month, not just helping people understand the importance of learning about financial literacy, but not just about learning, the basics and the terminology and, to implement it, because it's important to actually implement this in your lives, because we're finding people are carrying on too much debt, not having enough retirement savings. So I think this is a good month. Like every April we should, and probably every month of the year, to actually take a step back, look at our finances, look at our retirement plans, things like that, and reset and refocus.
Now, I have a question for you. If you've got nothing in your savings and you do get a little extra cash, is it better to put that towards your debt or to put a little bit in a savings account for a rainy day?
I'm a big fan of doing a little bit of everything. Now, don't focus on one. It is important to have that emergency funds. I think that's, you should have 3 to 6 months of your expenses in an emergency fund, which people found out last year how important that was if you didn't have that. So I think you should put out of every paycheck, have it automatically deposited in your checking savings accounts, have some money go into your retirement, and focusing on debt. Don't focus on one. Create habits overall for all of them.
And you're saying household debt is at an all-time high right now.
Yeah, it's over $6,000 of just bad consumer debt. But when we look at student loan debt, we're looking that's $35,000 plus for student loan debts for those who went to college. So it's an important thing to look at, because again, that's going to I know people in their 40s still don't have their student loans paid off yet.
And like you said, it can impact so many other things that you have to pay for. But at least paying off the minimum payments on your debts is kind of your advice.
Yeah, we don't want to be affecting the credit score, so make the minimum payments first on all the other debts, and focus either on the highest interest rate or your lowest monthly payment.
We know when we leave our money in the bank, for instance, I mean, the compound interest, it's not going to be significant over time. And that ushers us into the conversation about investing, because that's sort of the next level. When you have a little cash and you're ready to try to invest it, where do you even start?
Yeah, for most people, they start with employer-sponsored plans. Majority of people today either have a 401k, a 403b, 457 plan. So when you start your job career, wherever you get hired, make sure when you have that 401k available to you, put enough money to get that company match. That should be the question: is what does the company match? And I have to contribute enough to get that, right? So usually that's a 3%, 5%. It's pretty much standard. So you want to start there at least. And then you want to make it automatic. So when you open up that account, you should have it automatic where when you get raises, it's always a percentage of your income goes into that retirement plan. Okay, so 10 years later, you're contributing so much more. Hopefully you get in that 10 to 15% range, and really, hopefully, over time, you get to that maximum contribution. Right now, if you're under 50, your maximum contribution into an employer-sponsored plan this year is $19,500. And when you get 50 and older, it's a catch-up rule, which you can put $26,000. So I have several of my clients who are doing that. Obviously, they've been building it up over time. It might sound out of reach for somebody new, but when you start early, you won't miss it, and you create those good habits. Another quick thing, Aaron, on those 401k plans and starting early is Roth. Roth is great, especially a lot of Roth, these employer-sponsored plans have a Roth available to them. But unfortunately, the employers aren't very good about explaining that it is available. So many people come in here and they didn't know until the year of retirement or 2 years before retirement that they could be using a Roth in their plan. And that's where you pay your taxes today. It grows tax-free, withdrawals are tax-free, and that's most likely beneficial for most people in retirement. So if that is available, or if you're not sure is available, make sure you check with your HR department of your employer to see if that is, and you might want to be looking at that.
So you recommend a little bit in a Roth account if you can, and a little bit in a traditional 401k?
Well, I would recommend if you can put as much as you can or all your contributions into a Roth, I would really recommend that. But your employer doesn't pay your taxes. So when the employer matches, they don't match into a Roth, they match into the traditional. So your traditional is going to continue to grow. And the reason we like that, which kind of leads to our last topic about financial planning, is because When you get to the retirement, the least amount of taxable income you can have, the better.
Yeah, you're saying financial planning isn't just for people reaching retirement or people who have a ton of money in the bank. It's for younger people who are just starting out as well.
It is, and we're very fortunate. A lot of our clients are sending their children our way, so we're helping a lot of people in their 20s, which is fun to help them. They're already planning for their last day of work in their mid-20s and late 20s, which is great. I mean, what a great mindset to have. They're so much ahead of the game than most people, including myself when I was there.
Good advice. You'll find more money advice from Mike on WCCO.com.